Hi, I'm Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Center Tuesday Tips. We created our Tuesday Tips in order to provide you with quick, simple ideas to help you reach your retirement goals. For additional concepts on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
Hi, I'm Carson Graves, President and CEO of the Retirement Education Center, and I want to welcome you to our Tuesday Tips, where we are going to give you quick tips on how to maximize your retirement income. Now, today what we are going to be covering are ways to reduce your taxable retirement income. We always try to help our clients do this in any form and fashion that we can, and we're going to show you the ways that we utilize for our clients to help them minimize taxes on their retirement income. So stay locked in. One of the things that you're going to want to have to take note of when it comes to your retirement income is that the only number that really matters is going to be the income after taxes. That's the only number that's going to matter to you. Now, the question that you're going to have to ask yourself is, how do you maximize your income while minimizing those taxes? It's also clear to understand that different products and accounts are going to be taxed differently. Now, when you're looking at your taxed now accounts, it's going to be things like your CDs, savings accounts, money market accounts. It could be your non-retirement accounts, like in a brokerage account as well. These are going to be taxed right now, right away. And the only thing that's going to be taxable from those accounts will be the interest that you earn on those accounts later. Then you have a tax later bucket. This is going to be things like your 401ks, 403bs, 457bs, basically your employer sponsored plans. Traditional IRAs fit into that category, of course. Within this bucket, all you're doing is just kicking that tax bill down the road for a later date. But you do have a third option that we always like to utilize for our clients, and that is the tax-free bucket. Now, this bucket here is going to include Roth IRAs and even some life insurance plans. You're going to pay taxes up front. Now, when it comes to withdrawals, it's going to come out tax-free on the back end. That's very, very important to know that it's going to come out tax-free. Now, when it comes to life insurance, you're not talking about term life. Term life has no cash value. This is going to be whole life, it's going to be universal life, or variable life. Those are the policies in which you can actually take policy loans on and take income tax-free from those accounts. So what options do you have to potentially reduce taxes on your retirement savings? Well, one of the things that we always encourage our clients to do, if they're going to do potentially like a Roth conversion, is that we want you to take those distributions over a longer period of time and take smaller amounts. So for instance, if you're going to convert a $100,000 traditional IRA to a Roth, we're going to want you to maybe do that over a 5-year period of time. So one, you can stay in your tax bracket, and two, you don't have to actually carry that burden of a large tax bill right away. Another thing that you're going to want to try to do is have tax diversification within your portfolio. What do I mean by that? I mean that if you're going to take funds from your account, let's try to diversify where those funds come from. So some funds can come from your tax deferred account, like your traditional IRAs. Some can come from your tax advantage accounts, like your brokerage accounts. And here what you would be looking at are capital gains taxes, perhaps. And those could be taxed anywhere from 0 to 20% depending on your income level. And of course, last but not least, we're going to be looking at your tax-free accounts and pulling money from Roth IRAs. If you can have tax diversification, you can have more control over the taxation of your retirement income. Now, what's really important is that if you can harness the power of when, you can control taxes in your retirement, because tax diversification is going to give you flexibility and control to minimize taxes. Also, you're going to have the ability to guard against future tax increases as well. That's important because we have no idea where taxes are going to be in the future, but we all know it's not going to be zero. So take control over this situation if you possibly can. And last but not least, you're going to have more certainty with your retirement income planning if you can actually have more tax diversification and understand how to harness the power of when do you take those funds out. So I really hope that our Tuesday tip was beneficial for you to help you understand how to reduce taxes on your future retirement income. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. So if you are looking for a fiduciary advisor to help you with these types of complex financial matters, we highly encourage you to utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today. Also, if you do have any questions or comments about this particular video, please leave them in the comments section below, and please remember to subscribe to our channel, like, and share it with others.